I recently delivered a valuation to a business owner, and we had a great conversation around the valuation, but also the difference between goodwill and personal goodwill that a business owner has in the business. So if you're interested or want to know more about goodwill and personal goodwill as it relates to the value of your business, stick around. I'll see you on the other side. As always, if you've got questions as I go through this presentation, just leave them in the comment section below or pop me an email and I'll get back to you as soon as possible. And if you find something interesting in this episode, please consider hitting the like and subscribe button. And with that, let's talk about goodwill. So generally, goodwill is the intangible assets of a business, and it could include things like the business name, customer base, the reputation, the proprietary technology if the business has got any, location, website. So things that aren't physical assets of the business and or sitting on the balance sheet, cash, accounts receivable, but the intangibles that make the business run. How do you calculate the goodwill in a company? Well, goodwill is simply the difference between the company's valuation and or its purchase price minus the company's adjusted net book assets. Okay, so now what's adjusted net book assets? Well, to calculate that, you take the balance sheet, and from that, you're marking to market the fixed assets of the company and removing things like depreciation, amortization, any non-operational assets such as organizational costs, maybe tenant improvements. And then you're adjusting the liabilities as well. You may take a look at removing any non-company related liabilities that are associated with the balance sheet. And from there, you can simply take the assets minus the liabilities, and that'll give you the adjusted net book assets of the company. So a fairly easy two-step process as long as you either have a purchase price or valuation to start with. In this example, let's assume we have a valuation of $3,600,000, and let's walk through how you'd actually calculate goodwill. On the balance sheet, we've got assets of $2,244,533 minus the liabilities of the company of $1,644,948, which gives you an adjusted net assets of the company of $599,585. Now simply take that number from the $3,600,000 as far as the valuation, and you end up with goodwill of $3,415,000. You've calculated the goodwill of the company, and you're pretty comfortable with that. So the next step in this process is to figure out if any of that goodwill is attributed to a personal goodwill. Now, the test for personal goodwill is really around an individual's reputation, skill set, expertise, training, licensing that drives the majority of revenue through a business. So think about a good example is a chiropractor, single chiropractor in a location, a doctor that's got a small practice, maybe it's him and just a physician's assistant. And think about the goodwill that's associated in both those instances where the individual is responsible for driving the majority of the business through the office through his or her personal services. So how do you calculate the amount of personal goodwill that's in a business? Well, it depends. So let's talk about that first example that I talked about where it said doctor with a physician's assistant driving 100% of the revenue through that business. Now, there could be things where reputation, skill set, expertise Maybe some of that's related to the physician's assistant and just other people in the office that help it get going. But if you have a one practitioner office, and the goodwill's fairly large because it would be in a service type of industry, then it's probably 90% plus of the goodwill. So if you had goodwill of $3 million, then 90% of that would be attributed to personal goodwill. Now, if you've got a medical practice where you've got a clinic of, say, 10 doctors, and that one doctor is responsible for 10% of the revenue generated through the office, given the fact that it's a larger office, infrastructure, may have been in the community a long time, probably no more than 10-12% of the total goodwill would be considered personal goodwill, and it could be even less. In our first example, we had goodwill of $3,415,000. Now let's say we've gone through this process of trying to figure out the amount of personal goodwill associated with the owner-operator or a single individual in the business, and we've come to the conclusion that it's $1 million. So simply to split the goodwill up, you're going to have personal goodwill of $1 million and business goodwill of $2,415,000. So now you understand the difference between goodwill and personal goodwill. But why the exercise? Well, really there's two reasons. One is if you sell the company, the difference between personal goodwill and goodwill is a tax consequences. So you've got to talk to your tax accountant or CPA. But in personal goodwill, it's taxed at a long-term capital gains rate of 20% plus a 3.8% net income adjustment. So it's quite cheaper than you're being taxed on the goodwill side at an ordinary income. Also, the non-compete portion of an allocation of assets as it relates to a purchase transaction is also fairly significant. So a non-compete is actually taxed at a maximum of about 40%, again, versus the personal goodwill at 23.8. So there's a significant tax implication to the difference between goodwill, personal goodwill, and a non-compete. And here's my big disclaimer. Talk to your tax consultant before entering in or signing a purchase and sale agreement to understand the differences between the three. Now, in a divorce situation, let's say the company's valued at $3 million, and of that $3 million, $2 million is goodwill. Of the goodwill portion of it, you've calculated out, professional evaluator has done the job, and calculated that that goodwill is really split in two, $1 million for personal goodwill and $1 million for goodwill. Well, in the valuation, we will take the personal goodwill out of the overall value. So remember, we talked about a $3 million valuation, and for your divorce settlement, you'll take that personal goodwill of $1 million out, and then the value that's left over, in this case $2 million, would be subject to a settlement in a divorce situation. So a couple reasons why you should understand how they're calculated and how a valuator, or when you go to sell your company, how that might be calculated and put together in a purchase and sale agreement. Understanding the difference between goodwill and personal goodwill, fairly straightforward. Calculating the value of the personal goodwill can be a little subjective as far as putting that together and understanding that qualification. So I hope this episode was helpful and that you got something out of it. And if you did, please consider hitting the like and subscribe button. And with that, I'll see you on the next video.